Hello, everyone. I'm Todd Rosenbluth, head of ETF and mutual fund research at CFRA, and I'm excited to be joined by Jeff Given and David Bees. They are Manulife portfolio managers of the recently launched John Hancock Active Fixed Income Funds. Jeff, let me start with you. Could you just briefly describe your product that you're running, JHCB, the corporate bond ETF?
Sure. So our JCB is an actively managed ETF focused on the corporate bond market here in the US. We believe that over the course of the business cycle, there's a number of opportunities to add excess return versus passive benchmarks in this space. We've been managing corporate credit portfolios for over 20 years as a team, and we think that by focusing in this area, focusing on finding those opportunistic industries within investment grade corporate bonds, really diving down and finding undervalued securities within those sectors, and then following that up of optimizing how we own those through the maturity spectrum, we can add value through the entire business process. Our analysts do deep bottom-up fundamental work, really understanding the balance sheets of the companies, looking for opportunities for those migrations higher up in the ratings cap structure, or possibly unlocking value, even staying with similar rated securities because they're trading at a discount from peers for one reason or another. We believe this portfolio really is a core piece of any bond investor's fixed income overall portfolio, and it should be the mainstay to add that income component into advisors' portfolios.
Thanks, Jeff. David, so you're running JHMB, the mortgage bond product from John Hancock. Could you describe that briefly?
Sure. So JHMB is an actively managed ETF that invests across all sectors of the securitized market. It will maintain a minimum 50% in agency MBS and can invest up to 50% in securitized credit. Now, the investment objective is to seek a high level of current income while outperforming the benchmark over a full market cycle. As we manage this ETF, we're really focused on three guiding principles. The first is diversification. So it's diversification across all the major sectors within the securitized market. And that's really so we're not dependent on any one sector to generate all the return. Second is income generation. So if you look across the fixed income market right now, whether it's securitized assets, high grade or high yield, spreads are tight. And we feel the prudent way to manage the portfolio is by generating a lot of that return through income. And then lastly is risk efficiency. It's using our bottom-up fundamental quantitative analysis to find investment opportunities that have a high return per unit of risk.
Thanks, David. Jeff, let me turn back to you. You're focused on the corporate market. What's your outlook for the investment grade space today?
We're very positive on investment grade corporate credit as we're moving through this cycle. When you think of the environment that we're in, we've seen continued economic growth across the board in a various number of sectors. We're seeing more pricing power on the corporate side. We've seen this in a lot of the earnings announcements lately, where companies have been able to pass through price increases on their costs. So that should create a very good environment for investment grade credit to continue to outperform, hold their ratings, be able to de-lever a bit at the margin. And when you're looking at the big concern for most corporate bonds is really that downgrade to high yield. We're still seeing very, very low rates of downgrades. Most companies who are on that edge of investment grade versus high yield did get downgraded in 2020 in the heart of the pandemic. And in fact, we're starting to see that migration in the other direction. All of this should be very positive for investment grade credit going forward.
This is an ETF that you're running. Most of the ETFs that are out there that are tied to corporate are index-based. How do you differentiate what you're doing versus a more index-based approach?
Yeah, there's a few things. One, while we're aware of who the larger issuers are in the investment grade space, we're not tied to having positions in those issuers or even being at the same side. We do run very diversified portfolios. So let's face it, as fixed income investors, we have a lot of downside and really not that much upside, especially here in the low rate environment. So really diversification makes a lot of sense in this space, and not just blindly allocating to the larger issuers, the more debt-laden companies that are in the index. The other way we differentiate ourselves between the passive is really taking a look at the quality spectrum within investment grade credit. AA, single A credits oftentimes don't have a lot of excess return potential or a lot of return potential in general, and focusing on areas that tend to get a little bit more underlooked, maybe slightly more risky when you're looking on a broad basis, but you can find these diamonds in the rough, so to speak, in that mid triple B or low triple B area. Companies that really don't want to get downgraded to high yield, they want more flexibility that investment grade issuance gives them versus high yield issuance. You find those companies and you can really start to add excess return to an all investment grade credit based portfolio that's actively managed, not passively managed.
Thanks, Jeff. So David, I want to turn back to you again. You touched on it, but maybe you could just expand a bit on the team that is behind the mortgage bond ETF and your overall outlook on the space.
Sure. So JHMB really leverages the knowledge base across the fixed income platform at Manulife. Each member of the portfolio management team has over 20 years experience within the fixed income markets. Howard Green and Jeffrey Given are responsible for the core and core plus fixed income strategy at the firm, and they have really years of experience managing agency MBS securities within their portfolios. Peter Farley and I are responsible for the securitized asset strategies. We each have experience trading, analyzing, and managing securitized credit. So we really use a bottom-up approach that starts at the loan level for our security selection. We have an analyst covering each of the major sectors within the securitized space. Now they're set up as a sector specialist, so they cover from high grade down to high yield. They really use a fundamental and a quantitative approach in their research, and they leverage a number of resources that we have at the firm. So proprietary default models, as well as third-party models and data sources. And that analysis is really twofold. It's focusing on, first, on the quality of that collateral, and then two, on the quality of the structure being applied.
So I think probably the audience could benefit from just understanding a little bit more about the characteristics of the securitized asset market. Maybe you could just expand a bit.
Sure. So the securitized markets are very large, almost 13 trillion in aggregate. A large portion of that is the agency MBS market, but the securitized credit portion is approximately 3 trillion in size. And that's really where we see the more interesting investment opportunities. This part of the market, while large, can be segmented, and that provides exploitable inefficiencies. And that's something that we really love. Through our bottom-up loan-level analysis, we can source attractive investment opportunities. In addition, the securitized markets provide relative value characteristics and protection against rising interest rates. We typically are able to invest in securities that are higher up in the capital structure, but still offer attractive spreads relative to other sectors in fixed income. Many assets in this space are also shorter duration in nature. That's either as a result of the underlying loans. So if you think about auto loans that typically have a 5 to 6 year tenor, or through structuring of shorter maturity bonds. And then lastly, its ability to access floating rate coupons. Various subsectors within commercial real estate, asset-backed, and residential credit are structured with floating rate attributes. And these are the attributes that you want in a rising rate environment.
So I know many advisors that either own a broad benchmark that has exposure to the various bond sectors, or they try to build it themselves, but they're often focusing on government-oriented securities, treasuries, or corporates. That obviously leaves out mortgages and securitized assets. What is the benefit of having those two other sectors as part of the sleeve of the portfolio?
This is a common question that we get. I'll discuss 3 reasons why securitized, I think, complements traditional fixed income exposure. And that's lower correlations, higher yields, and diversification. So historically, securitized assets, and particularly securitized credit, has had a lower correlation with other parts of the fixed income markets. And that may result in less volatile returns when included in a portfolio. Second, securitized assets typically have higher yields when compared to investment-grade corporate bonds, especially in the front end of the treasury curve. So call it 5 years and in. Many times for a similar duration asset, we can add yield while moving up in quality. Over time, this may lead to incremental return. And then lastly is diversification. Securitized credit is a $3 trillion market and is often underutilized. It's about equivalent to the size of the high yield and bank loan market combined. We believe that a well-diversified portfolio should have a dedicated allocation to actively managed securitized to really maximize the benefits of this sector.
Thanks, David. So let's talk about how the portfolio is constructed and how it's different than some of those index-based products that are tied to the mortgage market.
So let me go a little bit about how it's constructed, and I think that will answer your question. So JHMB is constructed to have a minimum of 80% invested in mortgage securities. Now, the way that's comprised is 50% has to be in the agency MBS market, and then 30% can be comprised of non-agency MBS and commercial mortgage-backed securities. And then the remainder, up to 20%, can be invested in asset-backed securities. In addition, we have the ability to invest up to 20% in below investment grade securities. Now, this allocation will shift through time as the opportunities in the market change. Now, the combination of the agency and securitized credit really provides flexibility to navigate different economic environments. On the agency MBS side, through the active management of that MBS, we're able to mitigate some of the impact that the Federal Reserve, from the Federal Reserve's tapering of asset purchases. So a couple things we can do is shift our coupon distribution or invest in different specified pool stories. On the securitized credit side, we really like to diversify across all the major sectors. So taking advantage of ideas in residential credit, commercial credit, and asset-backed credit. We tend to favor shorter duration credit. So this means that returns are driven more from the performance of the underlying loans and less from interest rates. Lastly, we'll have exposure to floating rate coupons to protect against rising interest rates. So at the end of September, about 15% of JHMB was invested in floating rate securities. To compare, a passive mortgage ETF will only have exposure to agency MBS, which is almost exclusively fixed rate.
That's great. So finally, what's your current outlook for the mortgage market? Where do things go heading into 2022?
Sure, I'll start with the agency MBS market. Last week, the Federal Reserve announced the tapering of asset purchases at a pace of $15 billion per month. Now, this had been very well telegraphed to the market, so it did not come as a surprise. Our team view is that the majority of the impact of this tapering is largely priced into the market. But overall, mortgage OAS is still very tight, and the combination of additional supply that must be absorbed while also heading into a rising rate environment will likely cause spreads to widen a bit as we enter 2022. At this point, we see more interesting investment opportunities in the securitized credit portion of the market. Through our bottom-up research, we've identified opportunities in some of the more unique asset-backed sectors, such as franchise restaurant, asset-backed securities, or shipping containers. Within the CMBS market, single asset, single borrower sector, that provides us exposure to floating rate securities. And in the non-guaranteed residential credit portion of the market, it continues to benefit from the strength in the housing market. With JHMB, the product is really designed to take advantage of all these more unique sectors within the market.
Thanks, David. Thanks to you and to Jeff for giving perspective to CFRA's clients about these new actively managed fixed income ETFs, what makes them compelling and what makes them different from some of their peers. So thank you very much and have a great day.